All our delegates attending this afternoon session after lunch, and thank you for my panelists on stage. I'll sort of briefly introduce them, starting with Emma Townshend from Impala Platinum, Adrian Hammond from SBG Securities, Mark Augustynak from ICBC, Standard Bank, and Kenny Hu from Citibank. I think for the purpose of time, we're going to jump straight into things because I think we are running a little bit late. So Mark, I think I'm going to start with you because chatter around this SPW 2025 has clearly been about platinum prices and the strong performance thus far this year. We have seen a strong run in prices over the last 2 months. So what are you actually seeing on the trading desks from your clients? And what has really been different compared to the last 5 years where platinum prices have really been range bound?
So just maybe I start for the last 5 years, what has happened. The market was in a range between like $900 and $1,050. And there was, which is forgotten recently, is there was always, in these last years, always demand around the 900 to 920 area, and from Asia especially, and in physical demand as well. What was different to basically within the last 10 weeks is there was quite a lot of demand ahead of the London Platinum Week, around the levels of 950 to 1,050. Which were mainly coming from Asia and in specific China, and that was most of it for physical delivery. What has changed here is when we broke out of this range, there were other factors coming into the market. The CTAs who were short had to stop out. We have momentum CTAs coming into the market. There were actually hedge funds being back into the market and an interest, and at the very end there was a story to sell onto it was outside, it was not gold, it was not silver, it was platinum, and there was a story to sell, and that was strong demand we have seen hitting a very tight primary and secondary supply. And I don't want to go too much into the details because we have better experts for supply and demand here.
Well, we'll link straight into one of those experts right now, Adrian. As an analyst from a fundamental supply and demand sort of perspective, could you give us an overview on what you've been focusing on, which you think are supporting platinum prices at the moment? There seems to be some elements of both demand growth and supply risks.
Thanks, Wade. So I think before we discuss the price drivers, as a fundamental analyst, we always have to separate supply-demand fundamentals from speculative trade. And Mark is obviously the expert at seeing speculative trade, but from a supply-demand story, I would keep it short and say it's really about supply. In the last while, we've had quite a scenario with reduced supply coming from primary for mining. We've had some floods in South Africa that's reduced supply quite significantly, and we also had a lot of destocking last year from large producers that has helped tighten the market. So we are in an abnormally tight situation, and that's, you've heard about primary mine supply, you've heard about secondary supply falling over the last couple of years. That's been the trend, and I think will continue. Certainly in secondary, we're not seeing a recovery. So that backdrop already was quite supportive of price. We're now in a very, very tight scenario, but I think it will get better in 2H, but not by much. So suddenly you're seeing some price reaction, which is not surprising. But what's interesting from a demand point of view, we're not seeing it from traditional fundamental drivers. And you could also then argue the point that the price action in platinum is primarily speculative. So if you look at the flows that we see, you can appreciate that demand has picked up for platinum, and so you're seeing the price reaction in platinum. But you got to appreciate, as a fundamental analyst, you got to understand that the three metals have different exposures to industrial demand versus speculative demand, with the most being exposed to speculative demand is platinum, followed by palladium, then rhodium. And we haven't really seen much reaction in palladium and rhodium, but to be fair, prices are up about 20%. So that certainly supports the case for a tight market. So going forward, I would argue that we need to see rhodium rear its head first to support that the industrial demand is picking up. And that, for me, would be a fairly strong fundamental green flag.
Excellent. Thanks, Adrian. Kenny, I'll ask you the next question, and I'll sort of keep it to demand and specifically China. I mean, we've heard a lot of commentary around Chinese jewelry demand coming through this year. And I want you to put your commodity strategist hat on, thinking about gold as well. What is really driving the divergent trends between gold jewelry demand that we're seeing in China versus platinum jewelry demand at the moment? And what do you sort of need to see to sort of have more confidence that the Chinese jewelry demand story is sustainable?
Right, I guess to the first part of your question, right, which is what has driven this diverging trend between China gold jewelry demand and platinum jewelry demand. I think the simple answer would be price plus the marketing efforts. Right, the price part is easy to understand. In the past quarters, we've seen record gold prices because of all these geopolitical concerns, tariff concerns, right? So naturally, if you observe all the major demand categories for gold, gold jewelry tends to be the most price elastic demand sector. So naturally, you saw some demand destruction there, and gold being substituted by platinum. But I would also like to highlight the marketing campaign that we've been seeing, right? If you look at the price trajectory for platinum during this rally, right, it really started on, I think it was 19th of May, when you guys, the WPIC, were having their quarterly conference call on the Monday of the London Platinum Week. I recall that because it was late night my time and I still dialing, and you're welcome for that. But it was on that call that the WPIC highlighted these efforts, right? Like, for example, selling platinum products on TikTok, or how the number of platinum jewelry showrooms have tripled in Shenzhen, right, which is the jewelry wholesale hub for China, right? So I think that definitely helped. And to the second part of your question, which is what is required to see sustainable strength in China platinum jewelry, I don't think you can just simply rely on the price differential, because if you look at the gold to platinum price ratio or price differential, we've been making new records for quarters, right, until recently. And we haven't really seen a pickup in platinum jewelry demand until recently. So it was not just price, right? So I think you need to have more organic growth within platinum jewelry itself. And that means something like probably new products, right? Unique design that actually captures that demand from the jewelry consumers. And actually, it's not a very simple task, because if you look at what has happened over the past decades, right? 15, 20 years ago, we were talking about annual China platinum jewelry demand of 1.5 million ounce a year, or even 2 million ounce a year, and the number for last year was just below 500,000 ounce, right? So the reverse has been happening in the past 2 decades. Platinum has been massively losing out to gold in the jewelry space, and of course, there are a lot of reasons, right? The product design, the marketing, how gold is important, like cultural-wise for the Chinese people, right? Chinese people love gold for thousands of years, right? So there are a lot of concerns, and I think there's also this trend. Do not ignore it. Is actually, if you look at the gold jewelry demand in tonnage terms, actually being on a downtrend. Even within gold, jewelry has been losing demand to barring coins because people were educated that barring coins are better storage of value, right? You can trade in and out of it at a lower transaction cost. And of course, there's also economic growth concerns in China, which you see very high household savings rate, and that caps the consumption power, right? So there are a lot of headwinds. But I like to make a great example within the precious metal space, which is this company called Laopu Gold, right? I'm sure all the other Chinese participants are aware of this franchise. It's a startup, a jewelry company that has, I think, on average, probably double the margin versus the more established players in the market. And yet they still manage to capture a lot of demand from those more established competitors, right? In this broader, super competitive market, and it's because of their unique design, it's because how they cater to the, the cultural need. So I think it's not an easy task, like I said, but, if the platinum jewelry industry could figure out what the zeitgeist is, what the spirit of the time is, what people actually would love, and come up with great products, I think that is very important for us to see the, sustainable strength in this market, rather than like a, one-off substitution because of the record price differential.
Thanks, Kenny. Turning to you, Emma, and following on from what Kenny sort of elaborated with some strong demand growth in China's platinum jewelry, maybe you could sort of give us some color from a miner's perspective. How flexible is mine supply to respond to sort of emerging demand trends? And I sort of want to overlay that as well with a lot of your explaining how a lot of your supply is actually sort of contracted to sort of larger industrial clients, and how you can sort of become more nimble and respond to pricing dynamics as we see them currently.
Yeah, I think there are a couple of aspects to that question. So I think the first part is probably the simplest. We aren't nimble. The nature of the ore bodies, the assets we extract, the capital cycle, the time which it takes to plan, invest, commission, and produce from a South African mine is significantly longer than many other commodities globally, and significantly longer than most kind of industrial, factories or whatever the case may be. I mean, they then do tend to have long lives. So a long time to develop, but then a long time to kind of produce and generate returns. So our as a business looking for returns, that's got to be a significantly longer term view. So I think that's the one aspect, is we have to take a longer term view, because we have to allocate capital based on a longer term view. So I think the other aspect is, the nimbleness to respond to demand. I think a lot of the drivers of demand are kind of structural. I think they are based on long-term themes. I think you can have movements in price. I think you can have some variance in demand, like the uptick in jewelry or a surge in investment. But actually quite a lot of those, even still, are based on much longer-term cycles. Second aspect is this idea of how we sell. I think one of the things that South African producers have had to come to terms with is the role we play in terms of supply. So we are key to primary supply, but we are part of a network that includes closed-loop recycling and secondary supply. We've had a lot of discussion about that over the last couple of days. So I think that what we get from the nature of our contracts is we create stability and surety of supply for the long-term users of that metal. And I think it's a symbiotic relationship, and I think there's a huge amount of value in that. So I think there are other players in the market who have far more flexibility in terms of their business model and what they do to be more nimble. So Mark, for example, in terms of trading. But I think the nature of the contracts, the nature of who we have contracts with, I think that surety of supply, I think that's important for market stability and market development. And then, as you said, how do we be more nimble? I think the simple answer is we want as great a certainty as possible in the future demand for our metal. So, Valterra are absolutely phenomenal in terms of the way they put market development at the core. It creates again, a relationship, a sense of common purpose between customers, between suppliers. But I keep coming back to this theme that for us as producers, in terms of what we do, the nature of our operating context, we have to be thinking far more longer term than many of the other players in the industry.
Brilliant. Back to you, Mark. We've heard Kenny talk about some Chinese demand. We've heard Emma talk a little bit about some of the inflexibilities that miners have with regards to sort of short-term supply dynamics. I'm wondering if maybe you could sort of run us through what you sort of saw in terms of some of these supply dislocations that occurred at the end of 2024 and into 2025. And I'm specifically talking about how a lot of platinum shifted from European vaults into sort of North America ahead of tariffs, and what these sort of geographic dislocations can do to markets that you're sort of seeing?
Yeah, the tariff situation obviously was a quite challenging one, I think, for everyone involved, either it's a bank, a trading house, or any market participant. In terms of the platinum, I think it was a minor part compared to like gold and silver. And the main reason why platinum played a minor part here is because of the position limit on CME. I think the maximum amount a bank or a trading house can hold is like 1,000 lots, which is equivalent of 50,000 ounces. So it was relatively limited. And from end of November, where the first Trump comment on tariffs came to the market, to the peak, I think about like 550,000 ounces platinum made its way from London and Zurich vaults into the CME. One key point here is it obviously is not available in the market then anymore because it's allocated metal, which obviously was hitting a market which was already tight, as Adrian explained, on supply. And with the demand increasing, obviously the result were skyrocketing lease rates, or as we as a trader look like the swap rates were going in deep backwardation. After the tariffs basically didn't come into play, the whole lease rate situation eased, but still the number was still about like plus 10%. And it was still like in swap terms in negative territory before we then finally came, some people mentioned that, or Kenny mentioned that already, until the first news about the Chinese demand, which we obviously have seen prior at the desk, some parts of it as well, hit the market. And I think the problem then became more and more people involved into the market, not the CTAs. For the ETFs saw some inflows as well. And again, when the ETFs have a creation, it becomes allocated metal as well to make the super tight already situation again tighter. So available liquidity was very difficult, and again the lease rates went back up to in the region of like plus 15 to 20%. So it was a very, very challenging environment in terms of the dislocation here as well. And another point obviously is that the Russian supply is not coming to the market anymore, and that makes especially the palladium and partly the platinum market quite challenging as well.
Thanks, Mark. Adrian, turning to you, you're obviously from an analyst perspective, you're very focused on market balances, inventory movements, above ground stocks, etc. So when you're sort of looking at the interplay between these three factors, what do you think has sort of changed going into 2025, where, you know, over the last 2 to 3 years, we've sort of heard stories of OEMs holding excess inventory and working that sort of inventory down. What are you sort of seeing from that aspect?
Yeah, so let me try to answer that in two parts, because as I mentioned earlier, there's a lot of speculative trade in platinum versus palladium and rhodium. I think if you look at how quickly platinum price rose, not in my career I've ever seen platinum move so fast, so quick. And it does ask a lot of questions, because firstly, platinum is the most abundant of the PGMs, for one, and only about half of it is for AutoCAD demand. So it does ask the question then, is there much above ground stock at all in platinum? And if there is it in the hands of those who are not going to let it go? So it's really interesting to perhaps then assume that the platinum market is really tight. In palladium and rhodium, it's obviously a lot more different because it's industrial dominated. But firstly, I would say that autos production today doesn't necessarily correlate to palladium and rhodium demand today. OEMs will tend to hold inventory for various reasons, budgeting, their outlook, and of course security of supply. So during the Russian invasion and during COVID, we saw a lot of panic buying from OEMs. So they were buying metal forward. And that, of course, pushed prices up very high. It had the reverse effect, putting prices very, very low. We now think, though, those inventories are largely balanced. And perhaps the 20% odd rise in palladium and rhodium this year starts to indicate that the market is starting to tighten up. I would like to think it is, and certainly when we see rhodium rear its head above 6,000, that would be a solid green flag, in my view.
Thanks, Adrian. You sort of touched on palladium and rhodium there, and we've also talked about platinum strong performance. Emma, maybe you can elaborate for the audience just how miners sort of think about PGMs as a basket, and it's not necessarily just a platinum story. And when you answered earlier, you sort of talk about long-term sort of investment decisions and long-term supply outlooks. What are the sort of conversations that Impala and I guess miners in general need to have with their customers and the broader stakeholder collective to sort of ensure that enough emphasis and capital is allocated to sustaining PGM supply for the long term and their longer term needs?
Yeah, again, a question in a couple of parts. I think if we look at the last couple of years and the very strong cycle that producers enjoyed in terms of profitability and free cash flow generation, that was driven very much by rhodium and palladium revenues. And it was the kind of ultimate party before the hangover. So it was that absolute final flush of very, very strong auto demand. At a time when the future for auto demand was continuously being eroded by upgrades in terms of BEV forecasts. And that created caution. So as we look to that kind of long-term thinking and planning our business, as a predominantly Southern African producer, you know, the bulk of our metal by weight is platinum. And essentially, to continue to invest, you need comfort that the revenues, the kind of non-auto specific kind of palladium, rhodium revenues, have market fundamentals and an underpin that allows you to meet your required hurdle rates or an incentive price or whatever kind of metric you use. And the beauty of platinum is the diversification of its demand. The underpin to a variety of those sectors, whether it's jewelry or industrial or hydrogen over time, and just how big it is in our basket and the heavy lifting that it is capable of doing. I mean, the nickel, the copper, the chrome, the iridium, and the ruthenium, also, you know, that outlook is constructive and supportive. So for us, you know, when you see moves like this, and it comes from a metal where I think it's probably consensus. It's the one with the most supportive longer-term fundamentals that's gratifying. So the kind of moves in revenue, the fact that it's come from a metal that is material to us with positive long-term fundamentals creates greater certainty than if we'd had a rhodium spike or a palladium spike, because I think that there is a lack of confidence on longer term, you know, the ability to bank that and kind of reinvest it or counter it, you know, in terms of future revenue generation. I think also, though, I mean, you raise an interesting question. I think one of the huge things that's changed this year is that the supply dynamic came back to the fore in terms of the conversation. I think there's been very little about price and liquidity that suggested that markets were tight. Okay, I don't actually believe that consumers were anxious about supply and future supply. That had very little reason to do that. There was absolutely a concern on the invasion of Ukraine that, you know, you wouldn't get Russian metal flowing. It's flowed, it's created complacency. We've seen that thematic playing out in the financial positioning and the flows. And very importantly, the supply dynamic, constraints on supply, headlines on supply have supported price moves, and I think they've become part of the consumer conversation for the first time in a long time, and that's important. I still doubt our ability to sit down with consumers and say, you need to pay us this. Again, we're not the only suppliers of metal. So it's a very tricky one. We need to run a business. We need to run a business in a sustainable way, create value for stakeholders, be environmentally sound, create, livelihoods for our communities and our employees, and we also need to produce metal. But I think the balance of all of those things has become far more subtle from a South African producer perspective over the last decade.
Thanks, Emma. So, I guess in summary, supply is a little bit inelastic to prices. And so then, at least on the primary side, so Kenny, I want to talk to you about sort of other forms of supply and potentially on the investment side, where we've seen sort of strong prices in platinum so far this year. So in your opinion, where are we getting to a point where investors start to take profits and return metal to the market? How are you sort of thinking about that aspect of platinum at the moment?
Right, I think it really varies by the type of investor or speculator we're talking about, right? If you just look at the ETP holdings data, right, we already saw some liquidation, so people were selling to the market. That helped kind of ease the physical market tightness, right? But I think it really varies. I know some people who are bullish platinum all the way because of this consecutive years of deficit stock draw, right? Fundamentally, it's constructive. I know investors, these are more like long-term focused investors going in at 900, at below 1K, right? For them, today's price, whether it's 1350 or 1400 or 1300, does it make that much of a difference for them? Probably not, right? They're buying into the long-term future. But of course, there are also the other type of more like hot money, right? Which the other speakers have mentioned. For example, the CTAs or the algo funds. What they do is they almost pay little attention to fundamentals, and what they do is they just trade the technical, they follow the trend, follow the momentum. So when you have a price rally, they jump in, and what they essentially do is they further reinforce this trend, right? On the flip side, when you have a bear market, they dump their positioning, and that exacerbates the sell-off. And also, I think different regions, also you have different take profit patterns, right? Like in ex-China market, right, in the West, where you have a lot of instruments to trade as an investor, whether it's the futures and options or the exchange-traded products, right, with a very decent liquidity, you can easily trade in and out at very low transaction cost. But in China right now, the GFAX hasn't listed the futures yet. There's no domestic ETF that tracks PGMs, or not even domestic stock for PGM miners, right? So it's very hard for the onshore speculative community to participate through paper trading, and therefore most of the demand is actually physical, right? And it's easy to imagine, right? It's a lot harder to trade in and out of physical positions compared to the paper positions, like in ex-China markets, right? So I do think you need to think about the different types of investors and what their long-term or ultimate goals are.
Thanks, Kenny. And on the other aspect of supply that we haven't quite touched on yet, Adrian, is recycling. You sort of you briefly sort of mentioned that you don't think a lot of recycling volumes are coming back to the market. Maybe you could sort of elaborate on your sort of thinking around that.
So I think the sort of aspect of supply investors overlooked was the response that recycling had to low price. And I guess that answers the question around the difference between recycling as a source of supply versus mine supply. So recycling is clearly elastic, with volumes down almost 50% from the peak. That was the price response or the supply response to lower prices. So that's certainly a point to make that, well, then we should only expect recycling to come back when prices rise again. Our findings indicate that a lot of the recyclers are loss-making. What's hurting them, not just on the price, is also costs. So since COVID, costs have gone up significantly, particularly logistics and finance costs, and that's also not helping them achieve profits. So even with the platinum price up today, you got to understand that the contribution from platinum in an auto cat is very small. It's mostly palladium and rhodium. So that's not helping them much. In fact, they're still loss-making those sort of prices. Perhaps the very, very high, heavily loaded cats in the US are making money, but the rest are not. And for us to see a sustainable comeback in recycling, you actually need to see palladium and rhodium recover, apart from all the other wonderful things like interest rates and scrap rates. I don't think scrap rates is a real reason. Our indication is there's a lot of metal out there waiting to come. It just requires the right condition for it. And you'll be amazed to see how our price reaction, or how higher prices suddenly creates additional sources of supply. So I think we need to see those prices come back first.
So if we need to see prices coming back and sort of the supply response hasn't quite come to the market yet, Mark, are you sort of on the desk, you sort of seeing changes in buying strategies? You sort of briefly alluded to high lease rates. You used to be able to lease metal, 0%, 1%. It's now sort of been sticky above 10%. What are you sort of seeing from that point of the market in procurement strategies?
So I talked about a couple of times about the skyrocketed lease rate, which were going on for some times with a bit of a roller coaster, especially after the tariffs were not decided not to come. I think there is basically three potential strategies as a corporate treasurer you can do. Let's make an example. You have a 6-month lease. You go for an even more painful scenario and just do it 1 month in the hope that once the rates have eased out, or you do it instead of 6 months, you do it 12 months because the 12-month lease is lower than the 6-month lease. Still high, but lower than the 6. The third scenario you can have, just buy the metal. In all honesty, corporate treasurer are not speculators. They are not trader. They need the metal, they need the lease. So what I have seen, they stuck to their terms and have gone through the pain.
Great. Emma, turning to you, we obviously in China, and yesterday we had the Africa-China delegation, and mining playing a critical role for South Africa's economy. How do miners sort of manage their relationship with the likes of China, but also the West, where we've seen sort of rising, political risks since Donald Trump's re-election, and what are the sort of relationship management aspects that are involved with this? And we've also seen things like pseudo-resource nationalization, trying to sort of hoard metal, things like rare earths and potentially even minor PGMs, etc. So where do miners sit in this sort of landscape?
Yeah, I thought this one was an easier one, so I was grateful for that. I think the concentration of supply in South Africa actually makes us the belle of the ball. So a lot of our consuming countries don't have the ability to produce those metals. They need us. And we want to work with them because South Africa doesn't have the kind of industries that can consume PGMs in the quantities that we produce. I think we once did the sums, and total South African automobile production, I think, uses 12,000 ounces of PGMs. It's not going to take our metal. So I think that we probably fly slightly under the radar because the value of what we produce, the scarcity of it, and the requirement of South African suppliers very well recognized. I think there's a lot of education that can still happen. There's a lot of policy kind of debate and decisions, and there's a big role to play in terms of education and information sharing and collaboration. I think it's something the industry's good at. I think there are a lot of shared interests. Actually, and I mean, I raised it yesterday, and it's probably a little unfair. I mean, I think potentially where the conflict for us comes in is is South Africa's resource nationalism and a push for beneficiation, and for us to try and balance that with the needs of our very global customer base and their aspirations to grow their businesses. And we do that by education, by looking where we can participate in kind of nascent applications, you know, where we can create value domestically. But as I said yesterday, I think the creation of value and the role that producing a refined ounce in South Africa creates is very, very significant. It's not the same as exporting a ton of iron ore to be fabricated into stainless steel. It is a far more specialized, value-adding industrial process, and it's done in a way that creates disproportionate economic benefit and good for South African citizens. So that's where we actually feel the tension, is possibly more with our regulator rather than navigating global geopolitics, because there I think we're kind of in demand.
Brilliant. We've covered a lot of ground today, and I think a lot of the conversation has been quite positive in terms of prices and sort of demand risk. But I do think we sort of should touch on some of the potential risks facing PGM markets at the moment. We obviously do have the threat of tariffs, which has now been sort of kicked down the road by another month or so. But Kenny, I'll start with you. How are you sort of thinking about tariffs, and specifically if you could focus on the impact of tariffs on industrial demand for platinum? Do we sort of see a stalling of investment decisions, or do we see a sort of big wave of reshoring capacity to North America? What are your thoughts there?
Yeah, I think the simple answer is that tariffs are, of course, are negative for demand, right? But there are also, I think, some more like tactical trading opportunities arising from this tariff situation. If you just look at the data, right? I think Edward was giving a presentation this morning on this topic. If you look at Indians, jewelry export to the U.S., if you look at U.S. auto sales data, right, they're already going down. We had some month of strength early in the year that was mainly driven by this front loading of demand ahead of the tariffs, and now the momentum is already fading. So tariffs cannot be positive on demand. And in terms of the bringing manufacturing back to the U.S. story, right? Just think about it. If you are a factory owner in the U.S., or if you want to build a metal smelter, right? Not specifically for PGMs, but for any metal, right? You think about the copper or aluminum tariffs, right? Do you actually want to put up all that capital to build up the capacity? And it is the US, right? It's not in China where you can build a factory in a couple of months, right? In the US, it takes much longer. Investment, everything's more expensive. So as a business decision maker, right, echoing Emma's point of thinking about long term, right, would you actually want to put up all that capital investment, and instead of just paying up the tariff for this couple of years, and maybe years down the road there's a different U.S. administration, and all of a sudden global trade kind of coming back, at least part of it coming back, right? So it's really hard to see any positivity out of the tariff story. I don't think from the U.S. side it makes much economic sense to have for example, the Section 232 tariff on platinum, because the U.S. Cannot even meet its own demand, right, with domestic supply. For palladium, it's a separate story. They are actually a small net exporters. It's probably okay. But platinum, I don't think it makes economic sense. But of course, tariffs are not about making economic sense, right? It's about what the president wants to pursue, right? So there is that big risk here, and that's why I actually want to highlight this opportunity, which is in the the EFP market exchange. For physical market, if we look at the EFP rate, which essentially shows how much, what's the market implied probability or market implied effective tariff rate for platinum, it is just sitting right below 4% as of yesterday. And the peak we saw earlier this year was 8%. And if you track the NYMEX inventory for platinum, right, we saw the peak right ahead of the Liberation Day in April. But again, that inventory level has halved since then. So I think there's a lot of complacency in the market regarding this platinum tariff, right? And if platinum ends up getting included in this tariff, then it's likely going to cause another wave of market tightness. And if you look at what happened to aluminum, right, after they announced it, there's a short time window. And I think during that time window, people will be shipping platinum all over to the US again, right? If indeed platinum is included in a tariff, then you likely in that scenario also have tightness. You have spike on the EFP rate for sure, because it's so underpriced now. And also you have this artificial trade flow based tightness in the ex-US market that will lead to spiking price elsewhere, like local London, right? Because people are just shipping all the metal to the US. So I do think that is some, shorter term tactical upside opportunity in trading. But yeah, overall to your question, I think tariffs are bearish. It's just, the degree of bearishness we're talking about it is bearish for sure.
Thanks, Kenny. We've been flagged as being a little bit over time, so I think I'm going to close out the panel discussion there. I had many more difficult questions for Adrian in particular to follow, but I think all our panelists, I'm assuming, will be happy to take any further discussions in private with any of our delegates. So with that, I think I'm going to say thank you very much.